Welcome to The Explainer. Today, we're diving straight into the physics of finance and the hidden battlefield of the markets. We're going to fundamentally shift your entire perspective on market behavior. Think of it as taking the total guesswork out of trading by combining the immutable laws of physics with the hidden flow of institutional orders. If you've ever felt like the market is literally hunting your stop losses, well, you're going to want to pay close attention to this one.
Let's kick things off with a massive macro-level shift in how you actually view the charts. You know Newton's first law of motion, right? An object in motion stays in motion, unless acted upon by an external force. Well, markets strictly obey this law of inertia. A trend in motion stays in motion until a massive external force disrupts it. We often think of financial markets as totally erratic, but at their core, they are highly directional.
Just look at the trajectory of Lehman Brothers from 2004 to 2009. Retail traders just kept buying and buying as the price plummeted, totally convinced they were, getting a bargain. But really, they were foolishly stepping right in front of a financial freight train, fighting massive downward inertia until the stock quite literally hit zero.
Now, think about identifying strong trends versus weak countertrends. Trading with the flow of a strong long-term trend is infinitely easier than trying to predict a reversal. When the market pulls back in those weaker countertrends, actually, scratch that. It's not even a reversal, it's an opportunity. Fighting the market's primary current is just the ultimate rookie mistake.
So here's the crucial takeaway. The law of inertia in markets means that once a trend is established, it's just logically and mathematically better to bet that it's going to continue rather than reverse. I mean, you wouldn't buy a box of cereal at the supermarket just because they jacked up the price, right? But in the financial markets, buying into upward momentum or selling into downward momentum is exactly what you have to do, because those trends persist.
But, okay, this brings us to a pretty major conflict. If it's literally as simple as just following the trend, why do so many amateur traders still get completely crushed on the charts? You know the feeling. Why do your trades immediately go red the exact second you hit buy or sell? Well, here's the big revelation. Traditional support and resistance relies on dangerously thin lines. But the actual market, it absolutely does not pivot on a dime like that. It moves in thick, dynamic supply and demand zones. It's a completely different way of mapping the territory.
We really need to reframe the chart as a literal battlefield. These thick zones, they're the boardrooms of big money. When huge banks and hedge funds place their massive orders, they leave behind a massive footprint of unfinished business. They're accumulating or distributing orders within a whole range, simply because they're dealing with volumes way too huge to be filled at one single thin price point.
So how do we actually spot the footprints of this smart money? You're looking for a very specific three-step anatomy. Step 1, an impulse move. That's a really strong directional push. Step 2, a tight base, where all those institutional orders are rapidly accumulating. And Step 3, a sudden explosive departure away from that base.
And listen, the strength of that departure is absolutely everything. When you're analyzing this, notice the sheer size of the candles moving away from the base. A slow, kind of grinding move, that just means a weak zone. But explosive, super long candles that completely clear out previous swing highs or lows, oh yeah, that reveals a powerful institutional imbalance. It shows us exactly where the major players are fiercely defending their positions.
Now let's break down the two main anatomical footprints you're going to run into. First up, the rally base drop, or RBD. The price pushes up, pauses to form that base, and then drops like an absolute rock. This creates a supply zone, which is basically a ceiling of waiting sell orders. On the flip side, we have the drop base rally, or DBR. The price falls, turns sideways for a bit, and then rallies hard. That creates a demand zone, a rock-solid floor of intense buying interest.
And guys, here is where the battlefield gets seriously ruthless. Institutions actively manipulate the price to push it right into these zones. They are deliberately triggering your retail stop losses just to generate the massive liquidity they need for their own massive orders. So when you get stopped out right before the market goes your way, it's not bad luck. It's a forced, false breakout, engineered entirely by smart money.
Okay, but we have to address the climax of all these micro-level mechanics. Say you draw your zones perfectly. You patiently wait for the price. But why do some of these institutional zones hold like a fortress, completely rejecting the price, while others just fold like a cheap suit the very moment the price touches them?
Well, the answer lies entirely in identifying the fresh zone. We're talking about a pristine area on the chart that price has absolutely not revisited since that initial massive market imbalance was formed.
This right here is the secret ingredient.
Think of a fresh zone as a literal landmine just waiting to go off. Because the price hasn't returned yet, that massive reservoir of unfilled institutional orders is still sitting there, totally intact. The very first time the price returns to this area, boom! Those pending orders explode into the market, sending the price flying in the opposite direction. That first retest gives you the absolute highest probability of a strong reaction.
In sharp contrast, a heavily tested zone is basically a cracked dam. Every single time the price comes back to it, it consumes more and more of those pending institutional orders. This progressively weakens the zone until it inevitably just snaps and breaks. Honestly, if a zone has been tested more than twice, the big money is already gone.
Let's pull all of this together into a cohesive strategy, your new rulebook. You need to combine that macro law of inertia with the micro-targeting of the institutional battlefield. Rule 1, do not fight the trend. Rule 2, locate those thick zones where the big money left their unfinished business. Rule 3, always prioritize those explosive fresh zones. And most importantly, trade less and just patiently wait for the price to come to you instead of frantically chasing the market.
So armed with the physics of finance and the true anatomy of this institutional battlefield, I'm going to leave you with a final thought. Will you keep fighting the current with thin, fragile lines, just hoping for a lucky reversal? Or are you finally ready to trade with the flow and step inside the boardroom with the smart money? Thanks so much for joining me on this explainer, and I'll catch you on the next one.